Suddenly, everyone's talking about this one coin. They say it's the next 10x, the big opportunity. You feel the FOMO. You want in too. Because what if you miss the train and everyone else makes the big money? But what if I told you many of these hypes are carefully engineered with nothing real behind the coin? One of the most common tactics behind it is called wash trading. It's a method used to create the illusion of massive trading volume, just to make it look like everyone's buying. You see a coin with volume shooting through the roof. It seems like the entire market is trading it. Social media explodes, everyone's talking about it. But in reality, no one's really buying. No one's really selling. It's just a trick, and many people fall for it. Before we get to the trick, let's start with the basics. What exactly is trading volume? In simple terms, it shows how many coins move between wallets over a certain period of time. On the surface, it looks like coins are changing owners. But that can be misleading, because this signal can be faked, especially once you understand how it's calculated. Two things define volume: the size of each trade and how often trades happen. One trade with 1,000,000 coins? That's 1,000,000 in volume. 1,000 trades with 1,000 coins each? Also 1,000,000. The volume adds up, whether the demand is real or fake, and that's exactly what scammers exploit. Here's the core issue. Volume only shows that trades are happening. It doesn't show who is trading or why, and that makes it incredibly easy to manipulate. Wash trading means someone buys and sells coins to themselves. And in crypto, that's extremely easy. You can create unlimited wallet addresses, no verification, no identity checks. And on-chain, it all looks legitimate. Wallet A sends coins to wallet B, then B sends them right back to A. Or the trades go in circles, A to B to C to D, and back to A. The transactions are real, the coins move, but they never leave the hands of the same person. Still, every single transfer boosts the visible volume. Some wash traders use a few big trades. Others flood the blockchain with thousands of tiny ones. The result always looks the same: activity, momentum, interest, at least on the surface. And once the volume gets high enough, the dominoes fall. Analytics platforms show the coin as trending. Exchanges highlight it. Social media jumps on it. The hype begins. Real traders see the numbers and think, this coin is exploding. I need to get in. And that's exactly when the wash trader cashes out. Once enough real buyers enter the market, they dump their coins at inflated prices and leave everyone else holding the losses. Now, you might wonder, does this only happen in crypto? Not at all. Wash trading has existed for decades, even in traditional finance. But there, it's illegal and tightly regulated. You can't just open anonymous accounts. You need verified brokerage accounts. Trades are monitored. There are strict rules and real penalties. Crypto works differently. Wallets can be created in seconds. Most platforms don't require ID, and decentralized exchanges often have no way to detect wash trading at all. So, is wash trading illegal in crypto? Yes, it is. It is considered market manipulation. It creates fake demand, misleads traders, and distorts markets. Most major jurisdictions ban it. But enforcing that ban is difficult because on-chain, it's nearly impossible to prove that multiple wallets belong to one person. So in theory, it's illegal, but in practice, it's everywhere. Why does this tactic work so well? First, social proof. When it looks like everyone is buying, you don't want to be last. Volume feels like trust, even when it's fake. Second, algorithms. Exchanges and bots use volume as a primary signal. More volume means more visibility. Third, hype. Especially with small coins or NFTs, fake volume alone can create real momentum and real FOMO. So, how can you spot wash trading? Look for coins with high volume, but no real news. Be skeptical if the price barely moves despite tons of activity. Check on-chain data. Are the same wallets trading with each other repeatedly? And be cautious with projects that brag about volume, but say nothing about real utility. Because in crypto, not everything that booms is real. If you found this video helpful, give it a like and share it. For more insights like this, subscribe and turn on notifications. Thanks for watching, and see you in the next one.